We're delving into whether machine learning can uh, actually surpass human investors, particularly through analyzing adaptive herding behavior across the US, China, and India.
Yep,
The study uses data from 2010 to 2023 and brings in metrics like market sentiment, news sentiment, and investor happiness, right?
that's right. And it's interesting how they augmented the traditional CSAD method with dynamic inputs. It's like they're saying that herding isn't static at all. It's constantly evolving with, real-time market
Exactly.
moods.
Yes. And then they compared machine learning methods, both single layer and multi layer neural networks, to traditional approaches. Their ML models not only captured the herding behavior more accurately, but also showed faster normalization after major
Uh-huh.
macroeconomic events.
So, in essence, machine learning models are more responsive to sentiment shifts and market volatility. But hey, don't you think there might be issues with overfitting in these complex models when facing extreme events?
Well, that's a good point. I mean, the authors did indicate that during events like the COVID-19 pandemic, the ML models initially struggled, but then they adapted quickly, which suggests some
Yeah,
robustness.
true.
And they really highlighted how the ML approach showed lower CSAD values compared to the non ML method, especially in volatile emerging markets like China and India. It's like um, the ML models can cut through the noise faster than human investors prone to behavioral
Indeed.
biases.
Right? And they used rolling regression with 250 and 500-day windows to dynamically capture these herding effects, which gave more nuanced insights. It's almost as if, the machine learning models serve as adaptive sensors that recalibrate in real time.
Absolutely. Plus, their correlation analysis showed that higher market sentiment and positive news are associated with reduced herding behavior, while higher trading volumes push herding up. This interplay is captured significantly better with the ML models.
Yep, that synergy is quite telling. But here's a question. If ML models are decoding these patterns so well, does that mean we're moving towards algorithmic trading systems that completely sideline human decision making in the future?
That's a debatable issue. While ML is clearly superior in handling vast dynamic data sets and adjusting quickly to market sentiment, it still relies on historical patterns and human coded biases in training data. So there's still a role for human oversight.
Fair point indeed.
Moreover, policy implications from this research are pretty significant. They suggest that regulators might need to adapt their frameworks to account for ML driven trading to mitigate the destabilizing effects of sudden herding.
Yeah, regulatory adaptation seems crucial. And from a managerial perspective, firms could use these insights to design more adaptive trading algorithms that adjust for sentiment shifts, potentially reducing systemic risk during market downturns.
Exactly, it's all about having a dynamic strategy rather than static assumptions. Overall, this study challenges the traditional efficient market hypothesis by showing that with machine learning, we can better capture the dynamic nature of herding behavior, essentially moving beyond just price signals to include sentiment and behavioral
Yep,
data.
it's a fascinating step forward indeed. It really makes you wonder if ML can outperform human intuition in such complex scenarios. Perhaps we're on the brink of a new era in market analysis.
Absolutely, though we must balance automation with careful human oversight. For sure, that balance between advanced algorithmic strategies and human judgment could very well be the key to more resilient financial systems moving forward.
Absolutely, I totally agree.